Alright guys, welcome back to lesson 3 where we're talking about market maker conditioning and basic elements of trade setup. And we're going to continue from where we left off, where we're talking about consolidation. And I said we're going to measure the range of the old example we used on the last lesson, which is this consolidation. So instead of this, we have consolidation there. So we're going to use the replay tool on that, and we're going to watch the expansion. Actually, we're going to use this. Okay, this is a consolidation. So we're going to take this out. And with consolidations, we're looking for the equilibrium of the trading range, and we're looking for impulse price swings away from equilibrium. And then we'll also focus on breakouts of the false breakouts of the range, which I'm going to talk on shortly. But let's cover this. Now we have the market expand out of the range. So if we went to a 4-hour time frame, so you can see we have a clearly defined range, high to low. This is our overall trade range. So we're going to outline this. Now what we're going to do here is we're not going to use the wicks of the range. We're only going to use the bodies of the candle. Okay, so that is the body of our candlestick there. And we're going to outline 50% of the range or equilibrium of this consolidation. And we're going to get rid of this. And so that is the 50% of the range. And if we went down to a lower time frame, let's say for example a 15-minute time frame, you can see that the market gyrations keeps being drawn towards that level. Okay, so it goes up there and then trades lower. The market goes up there, trades above. And if I use the replay tool and I use 10 times speed, you're going to see the gyrations around that equilibrium of the trading range. So all the market is doing is the market is taking the average of that high to low, and orders are being built around that level. Now it does not have to be precise. Okay, all we need to see is just the orders being built around that mean threshold. Okay, so market builds in orders, goes back into discount, then goes a little bit back above. Again, you're seeing every time it goes up there, you're seeing the sensitivity right there. Once it trades above, that equilibrium should act as support in price. Okay, so every time we go back into discount, we're simply doing what we'll call averaging around the equilibrium of our defined trade range. Now we have a run of sell stops, so I think here it has to rally higher because of the run of sell stops. So you can see it's going back up there, goes back up there, takes out sell stops again. And what we're doing is, because of the proximity to this equilibrium, we're constantly taking out sell side and we're building in orders in this trade range. That's what we're doing. This takes long, so I'm going to use a 1-hour time frame just for speed. So again, you can see how the market gets. Oh, sorry. This is our equilibrium. That was actually an error. Okay, so we measured. Let's go back out to the far time frame. I'm get rid of this. So we measured the high, the low, sorry, of the range, the eye of that range. So the dotted line is actually the equilibrium. I was actually thinking it was the one up top. I apologize about that. So, alright, if we go back to the 15-minute time frame, you're going to see the gyrations around that mean threshold. Okay, so the dotted line is the equilibrium of that data range, which we broke down so far at price range, and we defined the high and low, and we identified 50% of the range. You can see here, you can see the sensitivity there. You see every time it goes on there, you get a little bit of a bounce. Okay, and this is evidence of smart money stepping in inside that trade range, and they're building in orders indicated by institutional sponsorship away from that trade range. So when we return back down into the equilibrium, you see it just a bounce again. It comes back down there, you can see the bounce again. It comes back down there, there's a little bit of a bounce. Now it trades lower below the equilibrium. Okay, that does not invalidate that equilibrium as a trade range. We're still building in more orders inside that trade range. So the market here is trading below the equilibrium and wants to spike above. This again is just all accumulation. So I wanted you guys to see in real time using the replay tool how orders are built around that area of equilibrium. And then what you get is once the market expands of range, then it will return back into that range. So we go back to the daily time frame, and I use a reset tool. You can see once we expanded on this candle out of that range, because I'm using the open of this, that makes the high of the range. You can see we return back down into equilibrium. Now we share the third a little bit, which is normal because again it's a daily time frame. But what I'm trying to emphasize is look at the way we're building in orders around the middle of this defined range. Now when we talk about false breakouts out of the range, we're talking about this, right? So we have a consolidation here. What was previous market structure? It was bearish, right? So if I use this replay tool here to cut off the start of the expansion, you can see we have a consolidation here. So what retail look at this as is consolidation, and they want to short the breakout. So you're going in to short the breakout of the consolidation because that's what the textbook teaches, right? When we break out of a range, you want to short the breakout to the downside, and then you want to go long the breakout to the upside. So they're shorting this. If they're shorting this, you're going to have liquidity resting above this high and also this high, and then ultimately this high where we have this range that starts from this high all the way down to the low. And you can see the gyrations there. The market eventually runs for the liquidity resting up above here after the fake out. So with consolidations, this is where you get your classic power 3 play, or what people on Twitter like to call, what institutional traders on Twitter like to call the AMD pattern. Now they only know about the pattern, so I'm going to write this out, AMD pattern. And what that is accumulation, manipulation, and distribution. So the accumulation is going to be the consolidation, the manipulation is going to be the false breakout out of that consolidation. Then distribution is going to be the market going in stream intended direction against all the orders that were manipulated against. So let me just show you guys conceptually using this range. So in this example, this is going to be our manipulation here, accumulation here, which is defined by the consolidation, and then the manipulation here sucks in retail to short the false breakout of the range. So this is your manipulation. So you have A, which stands for accumulation, you have M, which stands for manipulation, then you have D, which stands for the real and true distribution into an area of counterparty liquidity resting above the short-term high. So you still have the same play for reversal, which is a run on stop. What stop are we running out? We're running out sell stops. Remember when we talked about reversals? I think that was in this, right? When we're talking about reversals, we're dealing with liquidity pools. So what I did here is I blended the different concepts together so you can see how they work hand in hand with each other and complement one another for the market delivery profile. So this is where we talk about false breakout of range, and we're talking about consolidations, and also at equilibrium is where orders are going to be built inside a trader range. Now let's talk about market maker conditioning. I've talked about this on a previous lesson. I went into this in detail, and we're going to revisit that concept one more time in this lesson. When it comes to the market, in terms of how prices are being delivered, you have smart money, which engineers liquidity and delivers liquidity, and then you also have speculative uninformed money, which can fall under willing or unwilling liquidity. And then we have the market efficiency paradigm. And the market efficiency paradigm is the gap you have to bridge between what smart money is versus what speculative uninformed money is. And to be profitable consistently and do the things you see me do on the live session, that is the gap you have to bridge conceptually, okay, in terms of understanding. First off, and the first basic universal truth to price action is that the banks drives price. The central banks are the storehouse of a currency, and price is controlled algorithmically. That's why I see inefficiencies in price, because it's being driven artificially through algos that drives the market for efficiency and transactional purposes. The small circle who understands what smart money is doing on a regular basis, they're not online and flashing their results like I do on Twitter. Okay, if you think what I do on Twitter is impressive, you need to see the guys who know these things, not from a conceptual perspective like we do. Okay, what we're doing on the lessons is we're trying to conceptually see what smart money is doing inside the candlesticks on a day-to-day basis. But these guys who are smart money, they're not doing this conceptually. They know the numbers, they know the levels, they know the areas, and they are way more precise that you and I could ever imagine. They're going into the market in 30-second time frames, and they're piling on orders. These are who we call interbank traders. All we're trying to do is we're trying as much as possible to mirror the actions of these interbank traders around specific interbank levels. And that's going to come in handy when we get towards the end of the course, when I start talking about what interbank levels are, how to anticipate them, and how to build in orders along with these individuals. That's who they are. And you have to bridge the gap between being uninformed liquidity to smart money with what I call the market efficiency paradigm, meaning the market is engineered to the absolute pipette. And if you can understand and accept this fact, then you can reach a level of precision that is rare in this industry, because you understand that the market is scripted, and just like a script, you act as the actor following the script. You're doing its directions. Okay, you're not trying to force your own or impose your will in the marketplace. Rather, you've accepted the market for what it is, that this is a market that is highly manipulated to seek unwilling liquidity and to collect profit or money from these entities into the hands of these small circle of individuals who are smart money. And that's why I tell people, when you're trading, you're actually playing the biggest game there is in the marketplace. You're playing the foreign market, which is the largest market in the world. Now let's talk about the interbank price delivery algorithm. In daily range structures, you have price equilibrium, you have manipulation, you have expansion, you have retracement, you have reversal, and then you have consolidation. So to view that conceptually, let's use the classic daily range profile. The classic daily range profile, you have consolidation, which we can term the Asian range. This is the classic daily range profile. And then you have expansion, which is the false break out of the Asian range during London session, or what we call jitter swing. When we get into day trading course, we're going to talk more in this classic buy template. And then you have number 3, which is reversal, which is London swings expansion. So London swings expansion is reversal against that jitter swing. And then number 4, we have retracement during New York session, where in New York we retrace into the range created during London session and then make its final expansion for premium going into London close, where we have distribution come to the marketplace. And then the market goes in consolidation until the next day. So to view that conceptually, we have let's see. We have, I think it is USCHF. We're gonna go down to a lower time frame on this pair. Actually, we're gonna use the Wanda because I think that was the previous one I did this analysis on. And to view this conceptually, consolidation, Asia range. So Asia range, universal time +1 for me starts around 1. Start of Asia range, end of Asia range, start of London session, end of London session, start of New York, end of New York / start of London close, end of London close. Start of Asian session, you can see the market declines, shifts into a little bit of a consolidation going in towards the end of London session, and this is your jitter swing. Okay, Asian range consolidation, jitter swing is your expansion. So you have a false expansion below the low from Asia. So that is this low here. We have very clean lows during Asia. You have a false break below that old low at the start of London session, which is your jitter swing, and then you have the real reversal in the marketplace come into play. So you can see before the reversal comes into play, we run out a liquidity pool. Inside the consolidation, we have a false break out of the consolidation. So you can see how we're building in these concepts together. So we have an amalgamation of consolidation, where we talk about false breaks, and then we also have reversal, where we talk about liquidity pools. So here we have consolidation plus sell side liquidity pool, market expands lower, and then reverses, and then the true expansion starts. Now in expansions, what are we primarily focused on? Possibility of a retracement. Where's the market going to retrace down into? Areas of inefficiency or fair valuation. Okay, now in reversals, where is the market going to seek? It is going to seek the opposing liquidity pools up here, where we have buy side liquidity. So you can see we have institutional entry drill into an inefficiency. We have expansion out of a base. This is a liquidity base, and the return back into a liquidity base. So if you went to a 1 minute time frame, this down candle, that's an actual trader range. We have expansion out of that trader range, so the market must return back into the equilibrium of the trader range there. Okay, so which it does, returns back down into the order block, which is what we're concerned with when we're dealing with expansions. Okay, market trades back down to order block, and then we see another level of expansion outside the range. Now we have a retracement down into an area of fair valuation, which is a small bullish fair value gap, and then expansion one more time to take out buy stops above the side. And then during the start of New York session, which starts here, okay, London launch going to New York session, we start to retrace. Where are we retracing back down into? We're retracing back down into a breaker block coupled with a bullish order block. Okay, this is a breaker block that took out a sell side liquidity here. So all this run lower originated from this up candle, so that's a breaker block. So we have breaker plus order block, okay, at discount. So what is the discount? We have a range, which is a swing low here, low, lower low, higher low. So that is a swing low right there. It goes past equilibrium of the range down into discount. So we're trading down into a discount, which is a confluence of a breaker block and a bullish order block around the start of New York Open again, which is gonna be retracement. And then we have one more pop higher for buy side liquidity. And you can see before we expand higher, we take out a short-term low, which is reversal. And then we have a range, and once we break out of that range in this candle here above the high of the order block, we retrace down into the equilibrium, or the 50% of the range of that order block. Then you see one final expansion through buy side liquidity. Then the market consolidates and then adds one more leg higher into London close and ends the day in the consolidation and resumes the same play during Asia. So that is a confluence of the price delivery mechanism, where you have price delivery, which is from consolidation, the market goes into an expansion, and then from expansion is going to go into reversal, just like we had here, right? Consolidation, expansion into reversal. Okay, and that reversal can goes back into an expansion. So reversal here, then the market starts to expand. Okay, and that expansion then can lead into consolidation again to building new positions. So what you have here is you have consolidation, reversal, expansion, back into consolidation, and then expansion again. So you can see the market is going to go from consolidation to expansion, right? It's never going to go from consolidation just straight up to reversal. It has to go from consolidation to expansion to then reversal or retracement. So the market is always going to go from consolidation to expansion, never consolidation just to retracement or consolidation just to reversal. It has to expand out of the consolidation first. And then once it expands, we have to start considering if we can identify retracements in the marketplace or reversal in the marketplace. This is price delivery mechanism. Hopefully this lesson was insightful. And on the next lesson, we're going to talk about impulse swings and market protraction. Enjoy your day.